The most dangerous moment in a bubble is not when the dream is fake, it is when the dream is real and the price is still wrong. That is the trap most investors never learn to recognize. They think a bubble means the technology is useless, the companies are frauds, and the whole story should be laughed out of the room. That is childish. Railroads were real, the internet was real, fiber optic cables were real, electric cars were real, artificial intelligence is real, space infrastructure may be real, satellite internet is real. The problem in a bubble is not always the invention. The problem is who pays for the invention at the wrong point in the cycle. A wonderful technology can change the world and still destroy the first wave of investors. A brilliant company can survive while the late buyer loses money. A railroad can connect a continent and bankrupt its shareholders. A fiber network can become the backbone of the internet after the companies that built it collapse. The world can become more productive, while the investor who paid the highest price becomes poorer. That is why I do not ask only whether artificial intelligence will matter. Of course it will matter. I ask who is selling, who is buying, who is forced to buy, who needs cash, who has paper wealth, and who will become the exit when paper wealth tries to become money. That is the first mechanism I want you to understand. I call it the liquidity gate. A liquidity gate opens when wealth on paper tries to become spendable cash. In normal times, that is easy. A little stock is sold, a buyer appears, the price barely moves. But in a mania, the paper wealth becomes enormous while the real cash available to absorb it remains limited. Founders, early employees, venture funds, private investors, and institutions may all look rich on paper. Then the IPO window opens, lockups expire, taxes arrive, debts need repayment, funds need distributions, and insiders want to turn marks into money. That is when the gate matters. A valuation is not cash. A funding round is not cash in the pocket of the seller. A paper gain does not pay a tax bill until someone else buys the asset. The bubble begins to crack when too many people try to convert paper into money at the same time. Ray Dalio said something close to this idea when he described the pricking of a bubble as the conversion of wealth into money. I think that is exactly the right frame. A bubble is not pricked because people suddenly decide computers are useless or rockets are silly or AI does not matter. It is pricked when the financial claims sitting on top of the story need buyers large enough to absorb them. And if the buyers are not voluntary, the system looks for buyers who are automatic. That is the second mechanism, the forced buyer machine. Modern markets are filled with forced buyers, index funds, target date funds, retirement plans, pension funds, insurance portfolios, ETFs that track a benchmark and must buy whatever the benchmark includes. These vehicles are useful for ordinary investors because they reduce cost and remove emotion. I have no quarrel with low-cost passive ownership as a general idea. For many families, broad indexing has been a great improvement over expensive speculation, but every machine has a weak point. If a company enters an index quickly at a very high valuation, funds tracking that index must buy. They do not sit around the table and ask whether the IPO is expensive. They do not vote on whether the founder is selling at the top. They do not study whether the earnings quality is strong enough. They follow the index rules. That means your retirement money can become a buyer. Even if you personally would have said no, that does not make passive investing evil. It means passive investing can become the plumbing through which a bubble distributes risk in ordinary language. That is exit liquidity. The third mechanism is the index door. An index door is powerful because it changes demand mechanically. A stock outside the index must persuade investors. A stock inside the index gets automatic demand from the funds that track the index. If the door opens quickly after a giant IPO, billions of dollars may need to move in a short period. The money does not appear from a magic. Well, it comes from selling something else, redirecting new inflows, or changing weights inside existing portfolios. That is where the squeeze begins. If a giant new listing enters the technology index, the money that buys it may come out of older AI winners. The proxy trade gets sold to buy the direct trade. For years, if investors wanted artificial intelligence exposure, they bought the companies already public. The chip maker, the cloud provider, the software giant, the data center supplier, the semiconductor equipment company, the AI proxy. But when the private giants come public, the market says, why own only the proxy if I can own the thing itself? So capital rotates. That rotation can hurt strong companies, not because they are broken, but because they became the funding source. That is the fourth mechanism, the proxy to primary rotation. The proxy to primary rotation is what happens when investors sell yesterday SAI winners to buy tomorrow. SAI IPOs. A semiconductor company may report good numbers. A data center supplier may show strong demand. A software company may raise guidance. But if the market has already priced perfection and needs cash for new supply, good news can become an opportunity to sell. That is late cycle behavior. In the early stage of a bull market, good news sends stocks higher because investors are underexposed and eager to buy. In the middle stage, good news confirms the thesis and draws in more capital. In the late stage, good news becomes a liquidity event. The stock is already run. The buyer is tired. The smart money sells into strength. The public asks why a company fell on good earnings. The answer is that the market did not need more proof. It needed cash. When a stock falls on good news, listen, it may be telling you that the market's problem is no longer belief. It is positioning. The fifth mechanism is the good news sell-off. A good news sell-off does not automatically mean the company is bad. It means expectations were already too high or capital is rotating elsewhere. When a major AI-linked company reports strong revenue, strong demand, and impressive customer growth, then still gets sold hard, you should not shrug. That is a signal. It tells you the crowd may have moved from discovery into distribution. Distribution is the opposite of accumulation. Accumulation is when strong hands quietly build positions before the public understands the story. Distribution is when strong hands sell into public enthusiasm while the story is already famous. The company may remain excellent. The stock may still be ahead of the business. That distinction can decide whether you keep your money. The sixth mechanism is the paper earnings loop. A bubble can hide inside earnings, not only inside valuation. People know how to spot a traditional valuation bubble. The price goes up while earnings do not. The price to earnings ratio becomes absurd. Everyone says the stock is expensive. That kind of bubble is visible. An earnings bubble is more dangerous because the earnings themselves may be inflated by circular capital flows, paper gains, and accounting effects. One company invests in an AI startup. The startup spends money back with the same cloud provider. The investor marks up the value of the startup. The cloud provider books revenue from the startup. Spending the startup raises at a higher valuation because it has access to infrastructure. The investor's paper gain supports reported earnings or confidence. The loop continues as long as financing remains generous and private valuations keep rising. The numbers look better than the cash reality. This is not necessarily fraud. It may be legal. It may be explained in footnotes. It may follow accounting rules. But legal accounting can still create dangerous economic illusions. The investor must ask where the free cash flow is, who is funding the spending, whether customers can pay without fresh capital, and whether the profits survive if private valuations reset. A business is not healthy because money moves in a circle. It is healthy when money enters from real customers and leaves behind durable cash. The seventh mechanism is the CapEx digestion test. Artificial intelligence infrastructure requires enormous spending. Data centers, chips, networking, power, cooling, land, transformers, construction, cloud capacity, and energy contracts all require capital. Spending can be good when it creates future cash flow. Spending becomes dangerous when it outruns monetization. If a company spends billions on AI infrastructure, the question is not whether the equipment is impressive. The question is whether the equipment earns an acceptable return after power, depreciation, employees, financing competition, and maintenance. A server cluster does not become valuable because investors admire it. It becomes valuable because customers pay enough to cover the cost of capital and still leave profit. That is the part people skip. They say AI demand is huge. I say demand is not the same as return on capital. A restaurant may have a line out the door and still lose money if the rent, labor, ingredients, and debt service are too high. A cloud company may have explosive usage and still destroy value if the infrastructure costs too much relative to revenue. A great technology can become an economic disappointment when the build-out is too expensive. The eighth mechanism is the retirement account funnel. Most Americans do not choose every stock in their retirement account. They choose a plan, a fund, a target date, an index, or whatever the employer made easy. Money flows automatically every 2 weeks. That money is powerful because it is consistent and unemotional. Wall Street loves consistent flows. Founders love consistent flows. Index providers love consistent flows. IPO sellers love consistent flows. If the largest new listings in history are placed into indexes that retirement products follow, the ordinary worker becomes part of the funding base. He may not know the prospectus, he may not know the float, he may not know the valuation, he may not know which existing holdings were sold to make room. He may only know that his paycheck contribution went into the plan again. That is both the beauty and danger of passive finance. It gives the worker ownership. It also gives Wall Street a river of money that can be redirected by rules. The worker never reads. The ninth mechanism is the supply shock in stocks. People understand supply shocks in oil, houses, or food. They forget stocks have supply too. When a giant private company goes public, it creates new stock supply. When several giant private companies go public together, the market must absorb a massive amount of supply. If the supply arrives at peak valuation and the demand is partly forced, that can mark a late cycle event. Why do insiders sell at the same time? They may need liquidity. Funds may be at the end of their life. Employees may want diversification. Taxes may be due. Private investors may want exits. Founders may believe public markets are offering the best price they will see for years. None of that is evil. It is rational. But you should ask why the smartest and earliest people are willing to sell to you now. Do not be offended by that question. Be protected by it. The 10th mechanism is the IPO top signal in history. Famous IPO waves have often arrived near moments of peak excitement, not always exactly at the top. Markets are not clocks, but when the most celebrated private companies all rush to sell at extraordinary valuations, the investors should take notice. The seller knows more than the buyer. The seller chooses the timing. The seller hires bankers to create demand. The seller tells the best story at the moment when public appetite is highest. That does not mean every IPO is bad. Some great companies went public and later rewarded shareholders, but even great companies can be poor investments at the offering price. Facebook became a great business, but the first public buyers still had to endure a painful reset. Other IPOs never recovered. The difference often comes down to price, lockup, profitability, cash flow competition, and whether the public market gave the company a valuation it could grow into. An IPO is not a gift to small investors. It is a sale. Treat it like one. The 11th mechanism is the lockup clock. When insiders are restricted from selling for a period after an IPO, the first public trading period may not reveal the full supply. The stock can hold up or rise because the people with the largest gains cannot yet sell. Then the lockup expires. Employees, venture funds, early backers, and insiders may finally sell shares. The market must absorb another wave of supply. This is why the months after a giant IPO matter. The opening day is only one event. The lockup expiration is another. The first earnings report is another. The first free cash flow reality check is another. The first week guidance is another. The first moment when a private valuation meets public market discipline is another. A stock can survive all of those, or one of them can become the trapdoor. The 12th mechanism is the narrow market warning. When a broad index hits record highs while more stocks fall than rise, pay attention. The index may be hiding weakness. A small group of giant companies can pull the average upward while the rest of the market deteriorates. The ordinary investor sees the headline and feels safe. The professional looks at breadth and sees fragility. A healthy bull market has broad participation. A fragile bull market rests on fewer shoulders. If nearly half of the index value is tied to one theme, then the retirement account that looks diversified may not be as diversified as the owner believes. 500 stocks on paper can still behave like one giant AI bet if the largest positions dominate the weight. That does not mean sell everything. It means know what you own. Diversification by number of names is not enough. Diversification by economic driver is what matters. The 13th mechanism is the oil rate vice. The AI bubble does not exist in a vacuum. It exists inside a macro world. If oil spikes, inflation pressure rises. If inflation rises, the Federal Reserve has less room to cut. If the Fed cannot cut, liquidity becomes more expensive. If liquidity becomes more expensive, high growth stories dependent on cheap capital face pressure. If yields rise, the discount rate rises. If the discount rate rises, long duration cash flows become less valuable. If corporate borrowing costs rise, AI CapEx funded by debt becomes more expensive. That is, the vice oil squeezes inflation. Inflation squeezes the Fed. The Fed squeezes liquidity. Liquidity squeezes valuations. Valuations squeeze retirement accounts. This is how a geopolitical event can become a stock market problem. It does not need to destroy AI. It only needs to change the cost of money while the market is already crowded. The 14th mechanism is the no rescue scenario. Investors became used to central banks rescuing markets. When stocks fall, the Fed cuts. When credit freezes, the Fed provides liquidity. When banks wobble, emergency programs appear. This history has trained investors to believe there is always a floor. But inflation can remove the floor. If oil is high, wages are hot, jobs data is strong, and inflation reaccelerates, the Fed may not be able to cut without damaging credibility. The market may beg for easier money, but the bond market may demand discipline. In that environment, the old rescue reflex becomes less reliable. That is when expensive assets learn what gravity feels like. The 15th mechanism is the technology. Investors split. A technology can win while investors lose. This is one of the most important sentences in this entire story. Railroads won, many railroad investors lost. The internet won. Many .com investors lost. Fiber optic infrastructure won. Many fiber companies went bankrupt. Solar power grew. Many solar stocks disappointed. Electric vehicles became real. Many EV investors lost money. The world rewards the technology over decades. It does not promise to reward the first public buyer at the highest valuation. That distinction is freedom. It lets you believe in AI without overpaying for AI. It lets you admire SpaceX without buying an IPO. It lets you know that Anthropic or OpenAI may matter without assuming the first public price is attractive. It lets you understand that future productivity may be real while current paper profits may still be fragile. The mature investor can hold two thoughts at once. The technology is real, the price may be dangerous. The 16th mechanism is the no IPO rule. I do not need to buy an IPO to build wealth. There are thousands of public companies with audited histories, management track records, cash flows, balance sheets, earnings calls, debt markets, and years of data. Why should a brand new listing at a record valuation get my money before it has proved itself in public? Sometimes an IPO falls after the first excitement. Sometimes lockups create pressure. Sometimes the market overreacts and later creates a wonderful entry. Sometimes the company matures, reports, disappoints, resets expectations, and becomes attractive years later. The patient investor can wait. FOMO says buy because everyone is talking. Discipline says let the sellers finish selling. If the company is truly great, I will have more than one chance to own it. If I only have one chance, it probably was not a great investment. It was a trade dressed as destiny. The 17th mechanism is the exit management rule. Staying invested does not mean sitting still with no plan. A person can own stocks, believe in long-term wealth creation, and still manage risk. That means position sizes, rebalancing, stop rules if you use them, valuation, discipline, cash reserves, a list of what you would buy during a correction, a clear idea of which holdings are core and which are tactical, a decision made before panic about how much decline you can tolerate. The worst investor is the one who says, I am long-term, when what he means is, I have no exit plan. Long-term is a strategy only when the asset deserves long-term ownership. Otherwise, it is an excuse. The 18th mechanism is the correction opportunity. I do not fear corrections. I fear being unprepared for them. A correction can expose weak balance sheets, punish hype, reset valuations, and create the opportunity to buy quality at lower prices. The investor with no cash, no watch list, and no temperament experiences a correction as punishment. The investor with a plan experiences it as inventory going on sale. The same sell-off can be tragedy or opportunity, depending on preparation. If AI-related stocks fall because liquidity leaves, some companies will deserve the fall. Others may become bargains. Great businesses can be sold alongside bad ones when funds need cash. That is why you do not abandon research in a bubble. You intensify it. You identify which companies have real cash flow, real customers, strong balance sheets, durable advantages, and prices you would gladly pay if the market gave you a discount. You do not wait for the crash to decide what quality means. Fear is a poor analyst. The 19th mechanism is the two-scenario playbook. Scenario 1 is the classic late cycle path. The market rallies into the giant IPOs. Passive money buys, proxies get sold, lockups expire, months later insiders sell, the weakest AI names disappoint, quality stocks correct. Patient investors buy the survivors at better prices. Scenario 2 is the macro break path. Oil spikes, inflation reaccelerates, the Fed cannot cut, yields rise, the cost of capital jumps, the IPO window becomes more fragile, highly valued AI names correct faster debt. Funded CapEx becomes a problem. The correction comes before the insiders have fully exited. In both scenarios, the same rule applies. Do not be forced. Do not be the automatic buyer at the wrong price. Do not build your retirement around one crowded theme. Do not confuse a technology revolution with a risk-free investment. Keep liquidity. Know your holdings. Avoid IPO FOMO. Buy quality only when price and evidence justify it. The 20th mechanism is the final mirror. If your index fund is about to buy the most expensive IPOs in history, do you know what it will sell to make room? If an AI proxy stock falls on good news, do you understand the rotation signal? If private valuations become public prices, do you know what happens to paper gains when the market disagrees? If oil spikes and the Fed cannot cut, do you know what happens to expensive growth stocks? If lockups expire in late 2026 and early 2027, do you know who may be selling to whom if a correction arrives? Do you have cash, courage, and a watch list? These questions matter because the next phase of the AI boom may not reward the most excited investor. It may reward the most prepared investor. The person who understands liquidity will not be shocked when paper wealth looks for cash. The person who understands passive flows will not be surprised when retirement money becomes the buyer. The person who understands proxy rotation will not be confused when good companies sell off on good news. The person who understands oil and rates will not expect the Fed to rescue every mistake. The person who understands history will not say, but the technology is real, as if that settles the investment question. The technology can be real. The IPO can still be overpriced. The company can survive. The late buyer can still lose. That is the hard truth. So do not let the financial machine turn your retirement account into somebody else's exit without your knowledge. Know what your funds own. Know how concentrated your index has become. Know whether you are buying businesses or buying excitement. Know your position sizes. Know your exits. Keep some cash for the moment when fear finally arrives. And when the great companies become cheaper after the crowd learns the difference between paper wealth and money, be ready. That is how patient capital wins. Not by mocking the future, not by worshiping it, by waiting until the future can be bought at a price that still leaves room for the investor to survive the journey.